Good day and greetings to you all. Welcome to this episode of the Macfin Insurance Forum. Today we are speaking to Yvonne Masiku, a very familiar personality in the insurance industry. And I'm sure you are dying to hear what she has to say about the most controversial topic in the industry, about credit ratings. Welcome, Yvonne.
Thank you so much, Simba. Thank you for giving me this opportunity to discuss with you on this very controversial topic.
Thank you. I'll just put you in the hot soup for once. Do we need credit ratings? What is it all about, credit ratings?
So, a credit rating measures the willingness and ability of an entity to pay its financial obligations. I believe credit ratings are essential, especially for capital markets, for people who want to raise debt. For example, a corporate that wants to raise debt, it's important for people to know the credit worthiness of that entity so that they're able to price that risk correctly. For insurance companies, I'll speak about reinsurance companies. I believe credit ratings are important for them because to participate on certain risks, people need to know how strong that entity is. So that's why reinsurers in particular need a credit rating. As for insurance companies, I think a credit rating helps to differentiate among local players within the market. So it helps to give people a competitive advantage for those who do have a stronger credit rating.
Interesting. So you are quite experienced in this field. Just give us a background of your experience, how you have come to be where you are now, so that at least our viewers can understand some of the sentiments that you are bringing along.
Okay, sure. So when I finished my first degree, I did my first degree in banking and finance and economics. I then went to do my master's in international finance, my MBA in international finance. And as part of the requirement for that program, I needed to do an internship. So I did my internship with Fitch Ratings in Italy, and that was my first exposure of credit ratings. So that's where I began to learn what a credit rating is, the importance of a credit rating, as well as how to perform credit ratings. So after I finished my internship, I was actually offered a job at Fitch Ratings. So that's where I began my career in credit ratings. So I did 3 years at Fitch before I had twins. Then once I had twins, it was very hard for me to stay on in Italy. So I decided to come back to Africa. And because my experience was within credit ratings, I looked for a credit rating agency within Africa. And the closest one we had was GCR Ratings in Johannesburg. So I was able to interview with them and got a job and moved to Johannesburg in 2013, going into 2014, yes, end of 2013 into 2014. I began working at GCR Ratings and in insurance ratings in particular. Within the 8 years that I was with them, I progressed from being an analyst to a senior analyst to heading the department as the head of insurance ratings. And then, yes, continued along those lines. And I think as I was working at GCR Ratings, a lot of the clients or a lot of the issuers that would meet would always ask us to say, how can we improve our credit rating? What do we need to do so that we have a better credit rating? And because you're working for a rating agency, you always have to maintain your independence. So it would be a conflict of interest for you to advise them in terms of how to get a better credit rating. So the idea of Serala Risks was born from those discussions where you realize that there's actually a real need in the market for people to understand how they can actually improve their credit rating, because a lot of companies don't understand what they need to do so that they have a better credit profile. So that's why last year I decided to leave GCR Ratings and start Serala Risks. So Serala Risks was born last year in June. So we started the company last year in June. And one of the major services that we're offering is credit diagnostics, ratings diagnostics. So what this means is we help entities from start to finish in their rating process. We help them understand how they can have a better credit rating. We also help them understand the impact that their strategy has on their credit profile, as well as how they can engage with the rating agency so that they're putting their best foot forward. Because at the end of the day, you always want to be putting your best foot forward, helping the rating analyst to understand your business model so that you can improve your credit profile. The other service that we're offering as a consulting firm as Serala is actuarial services. So we also help entities, with actuarial services, as well as training. And our training encompasses a lot of financial services topics. So, for example, we'll do training on understanding ratings, we'll do training on understanding financial markets, we'll do training even in terms of the actuarial aspects of the business. And then the last service that we're currently offering is in-depth market research. So what we do with our market research is a company can decide that they want to expand regionally. Let's say they want to go into DRC and they don't know much about DRC. So we're able to do the research for them, highlighting the strengths, opportunities, weaknesses, and threats within that industry, within that jurisdiction, as well as who the key players are, how big the market is, what market entry strategy they need to utilize, as well as the licensing requirements, so that when they do decide to go into that jurisdiction, they're well equipped and well prepared, and they've done the groundwork so that it's a seamless transition into that jurisdiction. Yeah.
Wow, that's quite broad, and should be very interesting to most of the insurance practitioners, in particular executives. Now,
yes,
we just want to unpack the issue of credit ratings, and probably you can touch on some of the risk areas also that are involved in credit ratings. Now, just want to understand, you have a company sitting in Africa, a company sitting in Asia, a company sitting in America. What level of confidence can I have when I see a credit report and whatever credit rating that you assign to that company? What confidence can I have that on a comparative basis, this is the interpretation of the report that I'm looking at?
Okay, perfect. So I think the thing we need to explain clearly is that we have what we call international scale ratings and national scale ratings. So with an international scale rating, that's where the comparability across globes comes into, across the continent, or across, yes, the different continents comes into play. So for example, an A- in Africa is the same as an A- in the US, is the same as an A- in Australia on an international scale basis, because they've measured the risks on an international scale basis so that they can make it all comparable, which is why you find that within Africa, we don't have a lot of highly rated jurisdictions or sovereigns or entities. So most of the entities within Africa are B- and below. I think Botswana was one of the few that was upholding us, but they got downgraded to BBB+, I think. So you find that, and Mauritius as well. South Africa is in the BB range now, and yes, which shows you that within Africa, we don't really have a lot of high international scale ratings. And because within a country, so for example, a company within whichever, let's say Ghana, a company within Ghana will then be limited by Ghana's sovereign risk on an international scale basis. Yes. So using international scale ratings, you see that's why we have a lot of compression within Africa with B-, most ratings not exceeding B- or above. Whereas now a national scale rating measures the relative ranking within one jurisdiction. So we cannot use national scale ratings to compare a rating in Kenya and a rating in Ghana. They're not comparable. Yes, they're not comparable on a national scale basis. What it means is within Ghana, for example, you can only compare companies within Ghana. Same with national scale ratings for Kenya, you can only compare ratings within Kenya.
Okay.
Yes.
Now, I think here is where much of the problem is. In terms of the sovereign rating, maybe you need to explain that first, what it means. But in terms of sovereign rating also, it means there is so much limitation that is placed on African domiciled entities or companies originating from Africa. And the clients on the ground, at what point are they supposed to make a distinction that here I need a national rating and here I need an international rating?
So I think, as we mentioned, so a sovereign rating measures the willingness and ability of a government to service its debt, for example. Yes. So that's basically what a sovereign rating is. And within Africa, because of high debt levels, high poverty levels, low income within the jurisdictions, you find that a lot of sovereigns don't have high ratings within Africa, which then has an impact on the entities operating within those jurisdictions. I think the other thing that you touched on then was on how a company can then decide whether to get an international scale rating versus a national scale rating. So for a primary insurer, because you're operating mainly within one jurisdiction, a national scale rating would make sense so that you're being compared with other players within your market. Whereas for a reinsurer who wants to operate maybe in different jurisdictions, not only within Africa, but within other international markets, then having an international scale rating would be beneficial, because then they can compare risks, for example, from a reinsurer in Africa versus a reinsurer in Asia versus a reinsurer in Europe. So that makes it comparable, also because they have limits in terms of the minimum credit rating that they want their reinsurers to have on the risks that they want them to participate on.
And so there's a sentiment that credit ratings sometimes give unfair advantage to certain players. So, for example, we can all be in Botswana, but there's an international company also competing in Botswana, and their parent is in a jurisdiction that has got a higher sovereign rating. How do you balance that? Because naturally, then there's advantage.
So the way that normally credit rating agencies would look at relationships or group companies is if you have, for example, a company that's based in Botswana but has a parent that's in the US or in Europe or wherever it might be, in a stronger jurisdiction, as you highlighted, if there's demonstrated support that the stronger entity or the stronger parent would be willing to support this particular entity in case of financial distress or in case of raising capital, then you'd find that this other entity within Botswana would have a higher rating because of that parental support that stems from the stronger jurisdiction. However, we also have to look at it on the reverse side. So you might find, for example, a company that's in Botswana, but its parent is in, let's say, Zimbabwe. And by virtue of the likelihood of the parent in Zimbabwe requiring the entity in Botswana to support them, then you might find that the rating of the company in Botswana is actually hampered or limited by the parent in the weaker jurisdiction. So it goes both ways sometimes.
In terms of risk, obviously, I think much of the credit ratings is based off risk analysis, risk assessment, and so forth. What are the parameters that you normally find problematic for insurance entities?
Okay, so I think one thing I remember when I first joined GCR Ratings, and our sector head at the time always used to say to us, if a company is going to fail or if something is going to go wrong with the company, it will usually because they don't have money. Their liquidity has run out, yes, or they've got issues with their corporate governance, where, issues have gone wrong with their credit rating. So those are the key things normally that you'd find that cause an entity to fail. So major issues that we look at and that rating agencies place a lot of emphasis on is liquidity and capitalization, because those two normally are what will cause an entity to fail. And working that through the cycle, you then find that a company's ability to earn real earnings or to have strong internal capital generation supports capital build, can support liquidity, depending also on what they're investing their money in. So you can have a company that's making money, but if they're investing in illiquid assets at a time where they need to actually pay their claims, they might not be liquid enough and then have to dispose of these assets so that they can become liquid. So I think those are the key things normally that you look at is your capitalization, your risk-adjusted capitalization, and your liquidity.
And in terms of risk, I mean, from your own assessment, have you found that there's a willingness for companies to improve their risk profiles over time through the ratings, or it just as it is, we are comfortable with being, in a junk status, so sort of to say?
So I think when I initially joined, this was about nearly 8-9 years ago, I think it took a while for entities to get to that point of fully understanding the impact that their credit rating has, even in terms of investor perception. So as we're going through the times, we're beginning to see that companies are becoming more aware of the importance of trying to improve their credit ratings. And unfortunately, for most companies that are operating within certain jurisdictions, it's always going to be a function of your sovereign ratings. So until you get to a point where sovereigns are engaging, governments are engaging and trying to improve their ratings, it's going to have that negative effect on companies, regardless of how well they're trying to strengthen their own credit profiles. So for as long as you're exposed to Ghana, you'll be limited by Ghana sovereign ratings. For as long as you're exposed to Botswana, you'll be limited by Botswana sovereign rating.
Yeah, but now, if I'm an insurance company based in Zambia and my clients are in Zambia, why should I be worried so much about the credit rating? Because at the end of the day, my sovereign rating is limiting what I can achieve in terms of the highest level of credit rating I can get. Why should I be worried so much about improving the parameters anyway?
Okay, so as we mentioned, so for example, if you're looking at your national scale rating, so as an entity that's Zambian and operating within Zambia, and your clients or your policyholders or your cedants are primarily Zambians, then you want to improve your credit rating because it gives you a competitive advantage. It also shows them. So for example, if I'm within Zambia, I don't want to have a double B national scale rating, yes, which shows that that's a weak level or weak ability to pay your claims or your financial obligations, whereas being a triple A within Zambia is a good thing. So it's understanding that progression, that even within my jurisdiction, I need to have a strong rating so that it shows my policy holders that I've got a strong ability or very strong ability to pay my claims or my financial obligations.
Yeah, so there's always a sentiment that a credit rating does not pay claims. What matters actually is paying claims, not me showing a report that has got a credit rating. And so many times we have these discussions on the table, and the argument always is credit rating does not pay claims. And sometimes I don't know whether it's justifiable or not, but sometimes we actually have situations where the companies that are poorly rated actually come to the party in terms of settling claims.
Woo, that's a very, very interesting topic for discussion. So remember that a credit rating agency relies on third-party information. So for example, because a credit rating doesn't actually do the audit, they rely on audited accounts from an independent auditor. They rely on actuarial reports or financial condition reports or actuarial valuation reports from an independent assessment done by the actuary, an external actuary. So a lot of the time they're depending on third-party documents that are viewed to be reliable and dependable to form an opinion and a view. And then sometimes not fully understanding. So for example, you can try to do a thorough analysis in terms of the claims ratio, for example. You can always try to do a thorough analysis in terms of, does the loss ratio make sense given the market, given what's going on in the operating environment, and doing that kind of analysis. But otherwise, to actually investigate to say, are they really paying claims, unless you've got information that's in the public domain that states that this company is not paying claims, or a regulator has stepped in to intervene because the complaints have become so severe that there's a particular insurance company that doesn't pay claims. It becomes hearsay, because you can go to markets and you can hear people talk about, for example, an insurance company that's not paying claims, but until it's verifiable, until a rating agency can actually find a way to incorporate something that's tangible into the analysis, it's hearsay. You can only do the analysis using the independent numbers that you've received. Yes, unfortunately. So
for you sitting at Serara Risk, I think the idea would be, is there a way to get companies to align their credit ratings to the actual practice on the ground? And I think this is probably where we need to be able to impress in terms of adding value, in terms of making sure that there is that appreciation of the value of a credit rating. What are some of the issues that you think companies need to do to align their credit ratings and their behavior in the market? So in terms of helping entities in particular, so one of the key aspects that people now look at is your management and corporate governance as an aspect. So you always want to make sure that management are on top of best practices in terms of even honoring claims, and being able to show that as a company, we are a company of integrity. We're a company dedicated to honoring the obligations that we have committed ourselves to. So it's always ensuring that management
understand that there's an importance in terms of being people of integrity, in terms of being people who honor their word, so that it's not a case where you receive premiums and then you refuse to pay claims. So you're building wealth on dishonest gains. So you always want to encourage them to have that concept in mind, to say, honor the obligations that you have taken on. Make sure that you're people who are providing best services. Because, for example, if you have a policyholder that you refuse to pay their claim this year on a technicality or on something that's not right, then you find that particular policyholder won't want to come back to you the following year because you didn't treat them right. So it's also being able to see how well they retain their policyholders, because they're always honoring their claims when they're due and within an efficient time frame as well, because you don't want to be keeping people waiting for a very long time to settle a claim that you know is due to them. So I think those are some of the discussions we have, even with management, when we're having these discussions in terms of formulating their strategies, to say, always ensure that you're treating your customers fairly. As we're moving towards treating customers fairly, always make sure that you're treating your customers fairly, so that you're also building a brand that will be supported by continuing business and new business, because your reputation goes out into the market that this is a company that will honor their obligations when they're due within an efficient time, and offering high quality service as well. So I think those are the discussions we also have when we're discussing, yes, building the business profile of an entity.
So these policyholders that you talk about, sometimes they are also a source of problem. I don't know whether it's from an understanding point of view or just ambition, but if we are to look at the scenario that our credit ratings in Africa are limited by sovereign ratings of our countries, why would most of the clients in any country insist to say, I want my cover to be insured by an A-rated client? Do you find merit in that request, or is just lack of basic understanding at a certain level?
So I think with a lot of corporates, so for example, corporate entities that are operating within any jurisdiction, they would normally want to be with an insurance company that will settle their obligations. At the end of the day, they want to be with an insurance company that they know will settle their obligations. So which is why you will find that credit ratings assist, even in terms of brokers. Brokers will want to place their business with entities that do have a strong rating within that jurisdiction, just because they've got that comfort to say, this particular company is going to be strong enough to settle whatever obligations come their way. So for example, if you have an entity that's struggling, or maybe that doesn't have a credit rating, versus a company that's got a strong credit rating, chances are the brokers will go with the company that has got a stronger credit rating, because an independent party has assessed them and viewed them to be able to pay their obligations at a strong or very strong level. Whereas one that doesn't have a credit rating, that either means the broker then has to do a mini financial analysis of their own to have a view of the credit worthiness of that entity, because you're not just going to place your business with an organization that you don't know. You don't know how strong they are, you don't know how liquid they are, or you don't know where their assets are placed, for example. So I think it also helps just having that third party view of having assessed that entity, gives a lot of people comfort.
And you talk of brokers, and saying we need to place business with companies that we know, and that's quite a very good point, and coming from the basis that our business is relationship based. Now, how much of your model factors in relationships? Because insurance and reinsurance is basically a relationship business. How much of that does your rating or credit ratings factor into the model?
It does a lot, and sometimes people don't understand where it comes in terms of the analysis. So in terms of the analysis, most credit ratings will look at a business profile. And within the business profile, they will look at a company's medium-term strategic objectives. They will also look at the diversification of business. So not only in terms of lines of business, but also by policy holder. And you also look at, policyholder diversification. So for example, if you find that 25% of the business is coming from Macfin, you also need to understand how strong is that relationship with Macfin, between Macfin and the insurance company. Because if Macfin and you guys don't have a good relationship, If Macfin decides to take their 25%, it means you're losing 25% of your book at any given point in time. You can actually lose that proportion of business. So you also need to see how strong that relationship is. How willing are they to come in year after year to keep placing business with you? Yes, continuously, and to ensure that that relationship is there. Yes.
So there's an analysis of either the diversification of the book or the concentration of the book, and you factor that in.
Yes, you do. And you also see, like, year on year, who is the major contributor. If Macfin is gone this year, the next year there's a new guy, then that year is gone. You then understand that this company doesn't have the ability to retain their relationships or to maintain strong relationships with intermediaries or with other parties within the market. Because you always have to ask yourself to say, why is it that you're finding year on year a change in terms of the composition of your policy hold of the people who are contributing business to you? Yes.
Interesting. Yeah. My other question was, is it fair for policyholders in Zimbabwe to demand that I want my policy to be insured by an A-rated reinsurer?
I think it's quite fair, depending on your risk levels. Some people might not be that concerned, but you'll find some people who are concerned to say, I want you to place my business with a A+ or AA- rated insurance company, because that's the comfort level for the risk I'm taking on. That's what I want. I want to know for sure that I'm going to get my money. I'm going to get my claim in case anything happens. So I think it's also based on individuals and their risk appetite.
So I suppose this is where you come in now with Serala Risk. And can you tell me, maybe in a structured way, what are some of the processes that you take your clients through, or whether it's an onboarding process or in terms of assisting them, I think, as we are closing?
Yeah. So in terms of onboarding, I do a lot of market engagement, and because of my previous experience with GCR ratings, I knew a lot of the players within the space, the insurance space. So it's building upon those relationships and doing a lot of market visits so that you're able then to pitch Serala Risks and the services that we're offering. I think the interest has definitely been there, where people have said that there's definitely a need for the services that we're providing. It's just a case of now building the brand visibility and ensuring that we actually build relationships with people, which then translate into tangible business results for us as a company. So we've managed to onboard quite a few clients. So normally that then takes the form of engaging with senior management, having the discussions, the negotiations, and just walking them through the process of understanding what we will do and what value we're adding as an organization to their entity. We've received very positive feedback in terms of the clients that we have serviced. I'm quite excited because we're actually seeing the tangible results from the rating that they had before they were working with Serala versus Serala stepping in and them beginning to see a positive or a better rating given the input that we had and the discussions that we have, as well as preparing them in terms of even answering the questions that the rating agency has. Having worked for a rating agency, you know how they think and you know what kind of answer will give them comfort. So it's also assisting companies to know how to present themselves truthfully in such a way that the rating analyst will understand the business model and the strategy.
Yeah. So just for clarity, you are not helping these companies to give the most convenient answer. You're actually helping them to resolve some of the critical risk areas, if I understand that.
That's absolutely correct. So our job is to help them so what I do for them is I do an analysis for them where I also highlight for them the strengths and the weaknesses of their business. So where we're discussing weaknesses, then you begin to talk about corrective measures that they can put in place so that when a rating analyst asks them to say, this is a weakness, they can say, yes, we know it's a weakness, but this is what we're planning to do to correct this going forward. So it gives them a forward-looking view in terms of even their business model, so that they know even when they're coming up with their strategy, what do they need to do so that they can mitigate the weakness and continue working on the strengths that they do have so that they get a better overall credit profile in the medium term.
Okay. And then my last question, do you think there is value in brokers getting a rating? I haven't seen much of ratings on brokers. Do you think there's value for brokers to have ratings?
I think it would be a very interesting concept to have brokers with the credit rating. I know a lot of brokers don't have ratings at the moment, and I know there's been discussions in terms of having a criteria that addresses brokers, credit profiles for brokers.
Mm.
I think in the medium term, it could be something that's very beneficial, also because as companies are interacting with brokers and brokers are interacting with people, you always want to know how strong is this party that yes, what's the risk
Yeah.
in dealing with Macfin, or what's the risk with dealing with a certain broker?
Yeah.
And it's nice when an independent party has done it for you so that you don't have to do it on your own.
Interesting. Thank you very much, Yvonne. I think our clients definitely are looking forward to engaging more with you. Hopefully that goes on well for you. I wish you all the best with your new entity.
Thank you so much, Simba. Have a lovely, lovely day.
Thank you. Thank you.